presentation is by Marcelo López. He's a founding partner of L2 Capital, a Brazilian-based asset management company, which operates a specialist uranium investment fund, which is managed by Marcelo. With over 20 years' experience in financial markets, he has lived and worked in the global financial sector in London, Sydney and Sao Paulo. Marcelo has a degree in mechanical engineering, an international MBA and specialisation in finance from Helsinki. And I'd invite him to come and give us his presentation, The Role of the Financial Buyer in the Uranium Market. Please welcome Marcelo.
Great. Oh, hi everyone. Hello. Hi everyone. My name is Marcelo. I'm a portfolio manager. I've been a portfolio manager for over 20 years now, and I have never in my lifetime seen such a great investment opportunity like uranium is now. And I'll show you why. So, sorry. This is the first slide. I'm obliged to put a disclaimer up there. I recommend everyone to read once you get the deck. So, as we can see by the chart, and this is the performance of the last 3 years for all commodities, uranium is the least loved commodity of them all. And on top of the chart, you have vanadium. And pretty high up, you have lithium and cobalt, which are metals highly associated with batteries and clean energy. But to me, it makes very little sense to have things that run on batteries if you recharge those batteries using electricity produced with coal. You're actually polluting more, as we've seen today a few times. So if you want clean, reliable, safe, and cheap energy, nuclear must be a part of the baseload. This is a chart of the uranium price since 1970 until late last year. And we're going to see a couple of things from this chart. First of all, we get to see that uranium cycles are very pronounced, both on the way up and also on the way down. And I would go as far as saying that the uranium prices are predictable. So you see there's an event here, prices spike, there's a nuclear accident, prices collapse. Then there's a big event, two of the biggest mines in the world go offline, prices spike. Then there's the great financial crisis, Fukushima, prices collapse. So where are we today? Well, today we are in a very similar position than in the previous bull market here. So the biggest mine in the world is offline. The biggest producer in the world, which is Kazatomprom, has already announced that it will cut its estimated production by 20%. Many more mines are offline or in care and maintenance. I'll call it a big event, so just wait for the price to respond. And the second thing that we get to see from this chart is that we are very close to the bottom here. And that's when you want to invest in a commodity, especially if you are a contrarian. Here is where the risk-return benefit is at its highest. So if something really bad happens, which I don't think it will, but if it happens, the chances for losing money are not too big. But if something good happens, and as we're going to see through this presentation, there are lots of good things that might happen, the potential appreciation is enormous. So why are uranium prices so low? Well, number one, obviously Fukushima. So after the accident, Japan shut down all its nuclear reactors. And even though it was taking delivery of some of its contracts, it was also selling them into the spot market, which obviously didn't bode well for price. Number two, the narrative. And the narrative was very bearish at that time. So people were saying that Japan would never more turn back a nuclear reactor. Spain was going to phase out of nuclear by 2020, Germany 2022, Belgium 2025. And every single environmental group was talking, putting pressure on politicians to either shut down existing reactors or at least not allow new ones to come online. Then you have a program called Megatons to Megawatts, in which Russia was dismantling some of its nuclear arsenal and downblending the highly enriched uranium into low enriched uranium and selling it to the US. So it was good for Russia because they get a little bit of money. It was good for the US because they avoided that uranium would fall into the hands of a terrorist organization or a rogue state. Plus they got another supplier of uranium. It was just bad for the miners. Also, we have over 500 companies in the sector. Even though most of them were just talking about uranium, still it's a huge number for a very niche market. Inventories have been increasing. There was that China was entering the market and utilities got scared that China was going to scoop all the inventory away and they couldn't sign long-term contracts fast enough. Then there's also Kazakhstan, which was increasing production. And as prices collapsed, Kazakhstan was producing even more, which obviously didn't help. And last but not least, with more spare capacity, the enrichers were spinning the centrifuges a bit longer, and the underfeeding has been increasing. So, what has changed? Well, number one, talking about Japan. Japan is back online. 9 reactors are already operating. 17 had applied for a license to come back online. They're building another one. And they have already announced that they want to achieve 20% of nuclear energy in their base load by 2030. The narrative has changed a lot. The likes of Peter Thiel and late last year, Bill Gates wrote in his annual newsletter about the benefits of nuclear energy. And to prove that he was just not talking about it, he decided to put $1 billion of his own money into the sector, and he's now raising another $1 billion from private investors to invest alongside him. Besides, Secretary Barry and Donald Trump are very fond of nuclear energy. The megatons to megawatts program is over. It was over in 2013. I don't think we're going to see anything like it in the near future for a couple of reasons. One, Russia has already dismantled most of the nuclear weapons that it wanted to dismantle. And two, because President Trump has already announced that he won't be signing any more non-proliferation agreements. So if anything, we're going to see a race to arms, which is obviously not good for the world, but for our cause, it's fantastic. There's also 40 companies in the sector at the moment, which is a very small number for uranium. 500 is too much, but 40 is certainly not the right number. Inventories have been decreasing. Last year, the production was around 138, 136 million pounds, and the consumption was close to 200 million pounds. So inventories have been drawn down. And obviously, if prices continue at these levels, we're going to see more drawdown of inventories. Kazakhstan now has listed Kazatomprom, and as a listed company, they decided to focus in profits, not production. I don't think they're going to increase production for a couple of reasons. One, if they increase, they're going to have to invest more in capex because they have already picked the low-hanging fruit. And if they invest more in capex, it means that costs will go up. If costs will go up, profits will go down. It's just the opposite of what they said. And number two, because utilities are not going to buy 100% of their needs from one country. It's just too risky for them. And in terms of underfeeding, it's decreasing. 13 new reactors should come online this year, another 13 next year. The enrichers will have less capacity, which means there's going to be less underfeeding. Now, uranium is a very simple story of increasing demand and reduction in supply. So if we look at the supply, I listed here a few projects and companies that have either shut down projects or put them into care and maintenance. But the important thing about the slide is to see that there's no McArthur River and there's no Cigar Lake being developed in this cycle. And that will be very important going forward. As a result, we're going to have 1.8 billion pounds of uncovered demand in 2035. And why is that? Is that uranium is rare or difficult to mine? Well, actually the problem is that the price is wrong. $24 is definitely not the price that uranium should be trading today. Most companies require a price above $40 to stay afloat. So people say, well, once the price gets to $40, McArthur River will come online, and the Kazakhs will produce more uranium and all that. No, prices need to go to $40 plus, not to bring new mines online, but to avoid existing ones going offline. In terms of the demand, we've done some work on it, and we've seen that demand has been growing by 1.7% per annum over the past 7 years. And we estimated that the growth will pick up from now and should be just above 2% per annum. And it's not only a story of population growth and clean energy, but if we look at the numbers, 140 nuclear reactors should be decommissioned by 2035, whilst 224 should come online by then. And this number 140 might surprise many people on the downside. Last week I was in Spain talking to the buyers, and they were completely unprepared to what's coming. They assumed that all nuclear reactors will shut down by 2020, which is next year, and they haven't bought any material. Now the reactors were granted extensions from 2027 all the way to 2035. So they have to go back to the market and buy this material. We saw a couple of months ago France as well giving another 10-year extension to some of its reactors, and also the United States. So this number 140 might be much lower than that. Now we see the sentiment is shifting, the rhetoric is becoming more favorable throughout the spectrum. The demand is increasing, but utilities are still not buying. Spot price has gone up, the term price are not moving because there hasn't been any long-term contract signed in the past few months. The price is very stable. And spot price, which normally used to be 10% of the market, is gaining importance simply because the term price are not there. Mobile inventories are at multi-year lows at around 209 million pounds. This is our own estimate, and I guarantee you we have the highest estimate of the sector. Most people have around 150, 160 million, and others have numbers way below that. But regardless of the number you pick, still the lowest level in many, many years. Financial players are catching up with the story earlier this time. In the last cycle, financial players entered once the uranium price hit $80 a pound. And at that time, it's very easy for people like us to raise money because we show investors that everything going up and they love it. Right now, it's very difficult to raise money, but now is the best time to invest. Now is the time that no one's paying attention and you can still find bargains. Price inertia leads to more potential cuts. As I mentioned, price needs to go to $40 plus, not to bring new mines online, but to avoid existing ones going offline. Once there's a realization that supply cannot be turned on quickly, we're going to see a big movement in the sector. I think most utilities think that Kazatomprom is there and Chemical just press a button and McArthur River will come back online. It's a bit different than that. Mines take years to come back online and go back to the previous production. They have to hire the people they sack, they have to train them, they have to spend a lot of money on capex, and they're only going to spend that money if prices are much higher than what they are now and sustainable. Now, this can lead to a possible overshooting. We have seen this in the sector before, and I'm not considering any black swans. Mines can flood, and countries can have problems. Now, what are the catalysts that we are seeing for this market? Number one, Section 232. And once the elephant is out of the room, I think it will open space for the utilities to come back to the market and contract again. And they really need to contract. By 2022, more than 70% of the long-term contracts will expire. And if they are not renewed now at much higher prices, the mines will be put into care and maintenance, which will make the situation worse. Now, I have no idea what's going to happen to Section 232. I don't think anyone knows. But a decision needs to be made to allow people to go back into the market and contract again. Once we see these new long-term contracts being signed, people will realize that the price is definitely not $24, $25. It's much higher than that, and that will be a catalyst to the sector too. Now, reactors are insensitive to the price of uranium. What I mean by that is that you spend $7-8 billion to build a nuclear reactor, and let's say this nuclear reactor needs 500,000 pounds of uranium a year. So if uranium prices are $25, you will spend $12.5 million buying the uranium you need. Now, if uranium prices quadruple, go to $100 a pound, you will buy $50 million of uranium per year. $50 million compared to $8 billion is a rounding error. It doesn't matter. What utilities need is that the material they get delivered is delivered on time and in the specifications they need. Price is not the major concern. Now, more reactors are being built, turned on, and there's been delayed shutdowns. The spot market might dry up. We've seen the spot market is a small portion of the whole market. And when you have the likes of Chemical and other funds that are entering the market, buying in the spot, that might cause prices to go up. There is this $30 psychological barrier that Brendan Monroe just there talks so well about it, and basically many financial players are on the sidelines waiting for a sign of renaissance in the uranium market, and they believe that once uranium prices hit $30 a pound, that will be the sign, and then there's going to be a new buyers entering into the market, making the price go up even faster. Now, we pay attention at the separative working unit price. We've noticed it's already been up by more than 20% this year. And we have the likes of Yellow Cake that's listed in London last year, raised around $200 million and used it to buy 8.1 million pounds of uranium. A couple of months ago, they raised another $30 million, used it to buy just over 1.1 million pounds of uranium. So it's 9.2 million pounds of uranium that's not going to see the light of the day, definitely not at these levels. You have UPC doing the same, and Overdance and UTC that are trying to raise capital to do exactly the same. Besides, another thing that might attract attention to the sector is the royalty company that should be listed by, well, probably this year. And royalty companies always attract attention to the sector. People remember Royal Gold that went up by 40,000%, or Silver Wheaton that went up by 45,000%. And royalties, every time there's a royalty in the sector, people tend to pay attention. Besides, there's a new index, an ETF, that also will bring more attention to it. So we're seeing now that disinterested investors is the opportunity of a decade for a contrarian investor. It's a great risk-return relationship, and to be honest, in my lifetime, and I've worked with emerging markets for many, many years, I have never seen such a great opportunity. But unfortunately, it's not for everyone. It's only suitable for investors with long-term vision and volatility tolerance, and that I promise you, you have. And the last thing, I just want to say what we look at when investing, and it's a good tip for companies that want to raise some capital. So the first thing we look at is the team. We would like a team that has experience, that has a good track record, that has done it before, has been successful, and has skin on the game. We want them to be shareholders and partners. Number two, we look at the project and the potential IRRs and compare with the other companies. We look at geography very, very closely, country risk, jurisdictions. For instance, Spain has a great country risk. It's a very low country risk, but to get a license to mine uranium there, it's not easy, to say the least. Peru is the same. It's a great jurisdiction to mine, but and you can mine uranium in Peru. The problem is that you cannot export, and because they don't consume uranium internally, you just end up with a pile of uranium there until they change the constitution. So that's important to look at too. Resources and scalability is something important for us. It's almost the same amount of work to mine 200,000 pounds of uranium a year than it is to mine 2 million pounds of uranium a year. So we tend to stick with the latter because the returns are much higher. We also want low financial risk, and we don't kid ourselves. The sector has been in a bear market for around 10 years now. There's no pristine balance sheet, but we want companies with low or no debt, preferably, and low cash burn. And last but not least, we want an advanced asset, some permitting in place, at least a pre-feasibility study. So that's it from me. Thank you very much. Appreciate it.
Thanks very much, Marcelo. Do I have a question for Marcelo? Dan's got a question.
Just a quick question, Marcelo. You talk about country risk. How do you see Australia's country risk?
Well, Australia is a country that is divided in